We're going to do 3 sessions today focused on hedging with options. My name is Ed Model. I'm the Director of Retail Education at the Options Industry Council. I'll be presenting session number 1. We'll also have Jamal Chandler, who's an instructor at the Options Institute at SIBO Global Markets for session 2, and my colleague Mark Benzequin, who manages the OCC Investor Services team for session 3. We've also got a 4th member of our team, Bill Ryan, in the back, who is also OCC Investor Services, who's going to be monitoring the online audience. So for those of you who are tuned in online, feel free to send off your questions. Bill will be monitoring those and responding live as best he can. And for those of you in person, we'll be taking Q&A at the end of the session. And you've got 3 hours and a lot of brain power ahead of you, so hopefully you can enjoy this. We are doing quarterly themes at the OIC, and as I said, we are focused on using options as a hedge. This first presentation is a little more on the basic side of protective puts, and we'll progressively get a little more advanced as we move along. Just to gauge the crowd, how many of you currently use options in your portfolio and have a familiarity with protective puts? Looks like just about everybody. So I'll try to incorporate something on the basic, intermediate, and maybe even somewhat advanced level in the first presentation to give something for everybody. First things first, our disclaimer. Options are complex tools, not suitable for everyone. You need to understand them thorough and complete manner before you use them in a live account. And nothing I say today should be interpreted as advice or recommendation. And that keeps me out of trouble, and at the end of the day, that's what's most important, keeping myself out of trouble today. So we'll be going through some examples, not using costs like commissions and taxes. Those are important in a live account, but we'll keep things simple today when we do our numbers and keep those costs out of it. The Options Industry Council, for those of you who don't know, was founded in 1992 by the options exchanges as a way to provide free and unbiased education to the public, to dispel myths that investors had about what options were, that they were too risky, that they weren't suitable for investors. So we've been going strong for 27 years. We have our education mostly housed on our website, optionseducation.org, in a self-study format, a lot of reading material there, podcasts, webinars, videos. We do 2 live webinars every month. And we have our investor services team that can be reached at options@theocc.com. You can send your email questions to that team, jot that down. You can also get copies of our presentations by sending an email to the investor services team. The industry as a whole has been doing incredibly well on an annual basis. You see a chart of volume here. And volume picked up greatly at the turn of the century. Right around 2000, 2001, you had a sharp increase in options volume. Certainly that was due to electronic trading and the speed and access that investors had to the markets. But also do-it-yourself investing took a strong hold over the investing world. And investors started to see just how beneficial options were to their portfolio. Back then and in the 90s, if I gauged an audience like yourselves and asked who was trading options, very few would raise their hand. Today, every single one of you raised your hand. And people are recognizing the value in the options product, and it certainly has shown in annual volume numbers. You see that spike there in 2011. For those of you in the markets back then, you may remember the sovereign debt crisis in Europe and the possibility that the Eurozone was going to explode. That caused elevated volatility throughout that entire year, and we had a spike in volume up around 4.5 billion contracts. The next handful of years were very encouraging for the industry, with volatility incredibly low and not much movement in the markets. The industry still remained and hovered around 4 billion contracts a year until 2018, with some micro and macroeconomic factors jarring the markets a few times, creating a spike in volatility. We set a record of over 5 billion contracts in 2018, and 2019 is also looking incredibly strong. So the industry is in a good place, and it's looking stronger moving forward. These are the exchanges where all the action takes place. When you send your orders in through your brokerage firm, it goes to an exchange. They receive that order and execute that trade. Also, the exchanges decide which stocks will get options contracts. Not all stocks get them. And the exchanges don't take that decision lightly. They have criteria that they use in order to determine if a stock is worthy of having listed options contracts. Some of those criteria involve being listed on a national exchange, having a price over $3 a share, a certain number of shareholders outstanding. Those are the kind of evaluating criteria that the exchanges use to determine if a stock is going to get options. They also decide what expiration dates to list and what strike prices to list and what strike price intervals to list. There's a methodology to that, but the exchanges give themselves discretion to give the investors anything they want. If there's a particular product that trades high volume, the exchanges want to give more strikes and more expiration dates. For lower volume, they may provide fewer. There's leap options, there's weekly options, and those come about because the exchanges see the demand from the public, and that demand is going up. If you're familiar with some of the more higher volume symbols, you're starting to see multiple expirations per week. Dial back a few decades, we were nowhere near that, but the volume has picked up so much, the demand from the public has picked up so much that the exchanges are now listing more options than ever. So here's my outline today. I'll start with put buying basics. We'll set the foundation there, and then we'll get into the protective aspect, the protective put. I'll analyze how many to buy in a couple of different ways from a few different perspectives, first from an equity perspective and from a portfolio perspective, and then we'll deviate a bit from the traditional protective put and get into put spreads, followed by Q&A. So first let's start with buying puts outright, which really is a speculative trade. So we're starting on the speculative side, and then we're going to translate this into the protective side. Buying puts, just like buying all options, confers rights upon the holder. When you buy an option, you pay for it up front, and now you own the right to execute a transaction in shares of stock. For that right, you've paid a premium. That's a sunk cost up front. And now, in the case of puts, you own the right to sell shares of stock at a certain price, and you own that right for a certain length of time, specifically the strike price and up until the expiration date of the options contract. You're buying puts outright as a speculative move, trying to capitalize on a market move lower. So if you have the right to sell shares at a certain price and the market continues to move lower, the right to sell shares gets more and more valuable. You're trying to capitalize on that move lower. So with a small cash outlay compared to some alternatives, you can buy puts and capitalize on a move lower in a bearish market. So let's look at an example. Stock is trading at $36 a share, and we're bearish on this stock. We want to capitalize on a move lower. We don't necessarily want to sell shares short or do another form of a short market trade, so we buy put options. We buy a 3-month 35 strike put at 2 1/4 in this case. Options are quoted on a per share basis, so 2 1/4 translates into $225 total dollars. And look at how this translates on a P&L graph. It's always useful to look at various stock prices at expiration and determine if the stock was at that level at expiration, what kind of profit and loss would I have? Now I have to identify this at expiration because prior to expiration, it's an imperfect science or an inexact science to know what the option is worth. Part of an option's price involves volatility. And prior to expiration, with a certain number of days to go, you don't know for sure what volatility is going to be. So you can't precisely identify what an option will be worth at some point in its lifespan. But at expiration, we know there is no time value. Volatility doesn't matter. And we can calculate an option's value based off of its intrinsic value only. So with certain stock prices, we can identify what our profit and loss is. And you can see with the long put, speculative trade, with the stock at or above $32.75, we make or lose nothing. That is our break-even point. We bought a 35 put for $2.25. We break even if that 35 put is $2.25 in the money, and that happens at $32.75. So if we're at 33.5, we will lose money on this trade. If we're at expiration and the stock is at 33.5, do we still exercise the put? You do exercise the put. If the stock is at 33.5 and we have a 35 put, we own the right to sell shares at 35. Stock is trading 33.5. It is still beneficial to exercise the put and capture 35. We're going to lose money on the trade, but it's still in our best interest to exercise at the better price than the open market is giving us. So as the stock moves down, we gain money. You can see on the right side as the stock moves to 30, down to 25, we gain more and more value. And this is where you can see how profits can add up when you speculate. When you buy options, you're spending a small amount of cash. If the market moves in your favor, you can make a very healthy return. There are an awful lot of guys out there who try to capitalize on this by broadcasting or advertising themselves as, say, options geniuses or options gurus who will be out there on TV or online saying, look at this trade I made last week. I made 800% return or 1,000% return. Who's seen those kind of ads on social media? You see them all the time. And they'll say, yeah, I just did this trade. Look how great it was. I made 1,000%. You can do that when you buy options. However, it is very difficult. You have to be correct on the direction of the move of the stock and the magnitude of the move of the stock and the timing of the move of the stock. If you're right on all three of those things, you can hit a very large percentage gain speculating by buying options, but it's not easy to do. The question I would have for those gurus is, how many 100% losses did you take before you made 800%? If you actually ever made 800%. So you got to be careful when you see those kind of things out there for anyone that says, I'm making tons of money, I'm making huge percentage returns. They're using the fact that it's possible in the options space. Speculating, I don't want to downplay it. There's a place for it if you are very confident in a move that's going to happen in a stock and the timing and the magnitude. If you buy options appropriately and responsibly, you can experience some healthy returns. Just be careful when anyone's out there telling you they do it all the time, because it's very difficult to do. Here's the P&L graph. I just translated those previous numbers into a profit and loss graph for buying puts. And our break-even point is the strike price minus the premium we paid of 2.25. Our maximum loss is how much we paid, $2.25. And this is where we make money and lose money. We make money to the downside. We have a limited loss to the upside. How many of you are familiar with Greeks? Delta, gamma, vega, theta. OK, let's at least introduce that here. I think during today's sessions, it might be beneficial to introduce Greeks on the simplest level. This is the most simple position we're going to look at today. And it might be easier to absorb what the Greeks are on this position. We are long a put option. Is our delta long or short? A lot of people raised their hands, so they knew the Greeks. Short. As the stock moves lower, the value increases for us. We want the market to move lower. So stock moving lower, option value goes up. Short delta. Short meaning we're capitalizing on the downside. What about vega? Vega is the move in implied volatility. Are we long or short vega when we're long a put option? It's fairly simple. When you're long options in general, you're long vega. An increase in volatility will increase all options prices. That positive relationship. Implied volatility goes up, prices go up. Positive vega. Negative vega would be selling options where the opposite occurs. And what about theta? Negative theta. Long options, generally speaking, with intrinsic value and extrinsic value are short theta, meaning with each passing day, we lose money, or there is a negative influence on the options price with each passing day. Now, I'll speak to theta for just a minute. It is generally understood that time decay is fairly slow when you go out further in time. And as you get to around 6-7 weeks before expiration, it starts to accelerate. And time decay begins to be more rapid at that time frame. Now, time decay will continue to accelerate all the way through expiration date. The quickest time decay you're ever going to see is on expiration date itself by the rate of decay. Think about an at-the-money option at the opening bell on expiration day that's worth a dime. At the closing bell, it's worth nothing. That is 100% decay. It doesn't get any faster than 100% decay. But is it worth selling an option for a dime? We're always trying to capture theta when we sell options. We're always trying to avoid it when we buy options. So you have to be wary and aware of where theta will work for you and against you, and then that will help you decide expiration dates. So we're short delta, we're long vega, we're short theta. We'll keep that in mind as we move forward into the more complex positions. So let's get to the main topic for today, and we'll have several examples of the protective put as we go through the presentation. In a nutshell, the protective put is a classic form of buying insurance on anything. If you buy insurance on a home, you buy insurance on your life, you buy insurance on your car. In this case, you're buying insurance on your money. Those are the most important things you own, the most valuable assets you have. And buying a put option allows you to buy insurance on your capital, on your equity. In this case, we're looking at a stock that may represent a large percentage of our portfolio, or we have a stock position that has moved in our favor, and we don't want to give back those gains. The protective put allows you to do that. Think about what it is. It gives us the right to sell shares at the strike price. There is a similarity between buying protected puts and constructing that trade to having a deductible and having a cost of insurance, just like you're familiar with any other form of insurance. In this case, we're still long shares of stock and we're still bullish, but we're concerned about the downside. So we still can capitalize on moves higher in the market, but now instead of having exposure to the downside, we have a protective put in place that locks in or guarantees us an exit price to the downside should something go wrong. And that's important. I can tell you from personal experience, one of the hardest trades to make, say undoubtedly the hardest trade to make, is exiting a losing trade. No one wants to do it. If something moves against you and gets red and gets worse and worse, it seems natural to want to hold that for it to get to break even or to get positive. Exiting a losing trade is very difficult to do. It's a discipline that's hard to learn. It took me many years. When I was day trading, I think I broke a few fists on my computer screen, watching trades that went wrong get worse because I didn't get out when I should. The protective put forces you out. Unless you go in and you do further management, if you own a put and you own stock, the position is in place. Your insurance cost is out, and now you're going to exit at the strike price no matter what happens to the stock. As long as you keep your hands off, it can't get any worse than that. Without a protective put, you're susceptible to moving your stop losses, to moving your alternative forms of getting out of a trade and allowing a bad trade to get even worse. So how do you choose a strike price when you're looking at buying a protective put? We've already said that the strike price determines what deductible you have. The difference between today's stock price and the put price will be how much you're willing to give up. How much of a move lower in the stock am I willing to tolerate before the protection kicks in? That's akin to a deductible. How much am I willing to give? So you'll need to ask yourself that question. How much protection do I want? And then how much does it cost? So the strike price helps determine what the deductible is, and the strike price in conjunction with the expiration date will help determine what option you purchase, what the cost is going to be. All along the way in the back of your mind, you can keep in mind what I just said earlier about theta and how 40 to 45 days, theta starts to increase and work against you, and it increases all the way through expiration. So we're going to go through an example and put these together. But keep in mind, options are written on 100 shares of stock. We're going to keep that in mind when we do this. One question I get when I go through the protected put is, what if I don't have 100 shares of stock? There are certain stocks out there that trade for very high prices. And I might have 50 or 25 or 75 shares. What do I do then? Can I buy a put option to protect that? And it's a great question. The answer is you can. But if you have less than 100 shares, you would be considered overhedged. You have more protection than you need. It would be similar to buying more insurance than you need on your house. You have a house worth $300,000 and you bought insurance on a house worth $400,000. You don't need that much. It's going to cost you more, but you can still do it. You would capitalize on moves lower if you did such a thing. But for our examples today, we're going to stick with 100 shares of stock. In this case, the stock's trading at $65. We're bullish and we're long the stock from 60. And we buy a put option that is equal to where we got in the stock in the first place. So we're looking at the 60 strike put option 3 months out for $1. That's going to cost us $100. And you can see the P&L graph here. At 60, that cost of $1 is not going anywhere. At 60 and above, our put option did not pay off for us. We didn't make any money on it. And it's going to reduce our overall profit. But on the right side of this graph, you can see as the stock moves higher, we have upside participation. And that's what we're trying to accomplish here. We're not bearish. We don't want to use insurance. You don't want to cash in your car insurance or life insurance, heaven forbid. In this case, we don't want to use our insurance either. We want the stock to move higher so we can continue to make money. The stock moves up 61, 65, 70. We still profit, and it keeps moving up, and we gain. But we always will gain $1 less than we otherwise would have. On the upside, the insurance cost us something, and we didn't need it. But again, it's not something you would regret. You don't necessarily regretting not cashing in your house insurance. To the downside, we're protected now. We have a position that is slightly positive for us, and if the stock turns around and moves lower, we can only lose $1 on this overall position. It is more frequent to see investors use protected puts when they have a position that has moved in their favor, such as this one, instead of buying stock and buying a put right away, which you certainly could do. But it is more often likely to see an investor, in this case, they bought shares at 60, stock's now up at 65, and they go down to the 60 strike, say, well, if this gets really ugly and they announce really awful reports, I'm not going to lose more than $1. I'm not going to see this winning trade get really bad for me. And that's what is useful when you are buying a protective put. And here's the P&L graph that it was just translated from the previous graph. As the stock moves up, we continue to gain, but our gain is less than the stock outright position. We give that up in the form of the cost of insurance. But to the downside, you see the big benefit where if the stock moves lower, we continue to have a flatlined P&L due to the protection that the put offers us. There are alternatives to buying a protective put. This is insurance, as I've said. But if you have a long stock position and you want to hold that for future upside gains, but you're concerned about the downside, what else can you do besides buying a put? What else would you do with a stock position, for example? Well, someone said covered call. You can sell a call to give you a little bit of a buffer to the downside. So that's a possibility. Put spread we're going to get to later today. That's a good call on that. You can do a put spread to protect your long stock. I'll go through maybe a few other more common ways. First of all, not use an option at all and use a stop loss. Forget paying for insurance. If I want to get out at 60, I'm going to put a stop loss in at 60. Right? You don't have to pay for that. There are benefits to that, and there are disadvantages to that versus using a put option. First of all, if you use a stop loss, it will work during open market hours. You're susceptible to gaps during those market hours, but you have overnight risk, you have weekend risk, you have long weekend risk when there's holidays. Your stop loss order is not going to help you if the market closes on Friday afternoon and then something happens over the weekend and you open up 5, 8, 10% lower on Monday morning, which has happened. Last time we saw that was August of 2015 when the market was down, the Dow was down over 1,000 points. At the opening bell, it triggered a lot of stops and a lot of margin calls, and it got very ugly on that Monday morning. Your stop loss doesn't help you if that's the case. So you're not paying for the insurance. That's the benefit. But you don't have overnight risk. You don't have weekend risk. One other way to distinguish between the two. Using our example here, stock's at 65. We want to get out at 60. If the stock drops to 60 and we have a stop loss order in, we're filled. We're out. If we own a put, we don't have to do anything. The stock can drop. You can have some macro or micro event that triggers a sharp drop in the market followed by a rally. We've seen this before. Fat finger events, flash crashes, an overnight crash after the last presidential election followed by a huge rally. You've seen these kind of huge drops followed by gains. If you have a stop loss in and your price is hit, you're out of that trade. It's over. A put option allows you to just watch the trade. This stock could drop down to 50, 45, then something fantastic might happen. The market turns around, rallies up back through 60. We still own the stock. We can still make money going higher. So there's differences between stop losses and protective put. The benefit of the stop loss is it costs you nothing. And then the negatives, like I said, gets you out of the trade as soon as that stock hits the price and you have overnight and weekend risk. Another alternative to buying a put option to protect a portfolio, I think, is just simply managing your cash position. Whether you're bearish or bullish, you could fluctuate your cash. Aggressive traders may fluctuate their cash position between 20% and 80% or 10% and 90%. When they're aggressive and they're bullish and they want in, they're all in. 80%, 90% in the market, 10, 20% in cash. When they want to be more protective and concerned about the downside, they size down. They increase their cash position. You can do that as well instead of buying a put. That would reduce your downside loss, although you don't get upside participation on a full-size position if you do that. Managing your cash position is probably something you all do, in addition to making sure the actual trade you have on is consistent with your market outlook. You're also managing your cash. There's really two sides to managing anybody's account. You're managing the positions against your market outlook, and you're managing your cash, your risk tolerance. Sometimes you can't take the trades you want, or sometimes you can size up on the trades you want because your cash position facilitates it. Sometimes you can't take certain losses. So you're managing both of those things. When you size down in cash, that's exactly what you're doing. So you could size down on the position side, size up in cash. These are alternatives to buying a protective put. There are some advantages to them, but there are some disadvantages as well. I'm going to move into a few more examples that focus on quantity and how many options you're going to buy with a few different examples. And the first one we're going to start with is going to be consistent with all three of these questions, which is how much time do I need? When you're buying insurance, how long do I want the policy to exist? How long do I want it to last? How much protection do I want? In other words, what's the deductible that I'm willing to take before protection kicks in? And then what's the cost? These are the three questions you'll ask, and then you'll determine for yourselves what the right option is for you. We have a stock trading at $100 a share. We are long 300 shares. Again, we're long from 95. It went up about 5%. We're concerned about the downside, so we want to protect the downside, and we use the options market to do that. On the options chain, we can see a number of different possibilities here, the 90, the 85, the 80 strike, and the bid-ask. Now, you're always looking at the bid-ask, the width, and determining, is this an option I want to trade? Sometimes it's not. If it's no bid at $5, do you want to trade that? Maybe you have to make that decision for yourself. In this case, the options are relatively workable. The 90 put option is trading for 5.25 bid at $5.40. The best price available right now for us to pay is $5.40. You can put in a market order and hopefully get $5.40. How many of you use market orders when you trade options? How many use limit orders? Okay, nobody uses market orders. Everyone uses limit orders. That's good. You can put in a limit order to buy at $5.40 if you wanted, or $5.50, $5.50, and get the best price that's available to you in case that $5.40 disappears. Or you can work something in between. I'm sure many of you do that. You'll work a 5.25 bid. See if you can get filled there, a 5.30 bid. In this case, we're going to work a 5.35 bid and get filled. So we buy 3 6-month out 90 puts. Now remember the time frame. I mentioned earlier theta, time decay, acceleration of time decay. We went 6 months out here. And I mentioned 6 weeks as when that decay starts to accelerate. So in our example, we went 6 months out. We're going to get very slow time decay for the 6 months until we reach that 6-week period. So we pay $5.35 for this option. Total cost for 3 of them is $16.05. First thing to note is we don't have to buy 3. We could buy 2 options. We could buy 1 option and hedge part of the position. That would leave us exposed to downside moves. But if we didn't want to pay this much and we wanted to protect some of the portfolio, we could buy fewer than 3. In our example, we bought 3, and you can see how this affects the right side of the equation. The profit and loss of the option is relatively simple. When it's at the money or out of the money, we lose our cost of $16.05, and as it drops, as the stock drops, we gain in value, and we continue to gain in value on the put option side as the stock moves lower. The stock position will continue to lose, but to the downside, that is offset by our long options position. So 31.05, that is the worst this position could possibly get. That's giving back gains and costing, including the cost of the option itself. To the upside, we participate. If the stock goes up to 100, we have a small loss. If the stock moves up to 110, We've now recovered all of that cost of insurance. We have a long stock position that'll continue to make money. And here it is on the graph. You see at the 90 point, we start to flatline where our strike price kicks in, and we have the right to sell shares. A good question to ask is, what do you do if that happens? What if the stock does trade down to 80, 75, 70? Well, like I said, prior to expiration, you don't have to do anything. You could just watch the trade and see if it turns around. But if you're 2-3 months from expiration and the stock just sold off sharply down to 80 or 75, and all of a sudden you're starting to turn aggressively bullish, what can you do then? You could sell the put, get rid of the protection. The put will be much higher in value, most likely, than what you paid for it. So let's say the stock drops down to 80, and you've got 2 months to go. And now you're thinking, well, that move is over. Bad earnings, it dropped, now it's at support, it's settled in, it's consolidating, it's going to bounce, I know it's going to bounce, I don't want this protection anymore. Cash out your put, cash out your insurance policy, and get rid of it. Pull that money in, increase your cash position, and hold long stock. That's an alternative in how to manage the money. But it's not an easy decision to make when that stock is moving lower and lower. It's not easy to get rid of the insurance that has been benefiting you, but your market opinion and market bias will precede that. Your position needs to be consistent with your market outlook. If you've turned aggressively bullish and highly confident that the stock is moving higher, getting out and selling your insurance at a profit and then moving on with a long stock position could be the way to go. So you see the break-even point up above 100. That's because we paid $535 for the option. The strike price was 90. We paid $535. The stock is at 95. That's where we're long the shares. So we have to recover all of that cost of insurance at expiration before we start to profit. So break-even point up at 135, and then maximum loss would incorporate the stock move and the cost of the insurance itself. The second example here is going to change perspective a little bit. It's always interesting to hear from an institutional investor or an advisor who's working with a large portfolio and they want to protect the whole portfolio. The examples we've gone through already are protecting shares of stock, a solo singular position. Oftentimes, investors want to protect a portfolio. And it's a little bit different how you do that and how you calculate that. So we'll walk through an example. The investor has a $100,000 portfolio, and we have to stipulate that it reflects very closely a broad-based index or ETF. And similar to before, market outlook, we're bullish. We want to hold this portfolio long in the market, but we're cautious. We think the stock market might be susceptible to some type of news, political or economic, and we're going to want to buy protection on the portfolio as a whole. So we need to identify what product we're going to use to hedge the portfolio. And that's the presumption we have to make here, that your portfolio resembles something that you can identify that trades options, and we are going to use that as our protection. We've decided that 10% is the deductible we're willing to accept. In other words, we have a $100,000 portfolio. We'll accept the first $10,000 loss, the first 10%. But if it gets worse than that, we want protection. We'll give up the first 10 and protect the rest of the 90. If the index or ETF that we've identified, which corresponds greatly to our portfolio, is trading at 250, and we experience that 10% drop, that puts the ETF around 225. That's the 10% out of the money put that we'll want to purchase here, the 225 strike. So we've clearly picked the strike based on the deductible. We go out, in this case, 30 days. We want 30 days of protection. We're not concerned about the market at this point beyond that time, and we see it's trading for $3. So we have a few pieces to the puzzle. We know what strike price we want. We can see what it costs. We've identified the expiration date. The next question is, how many do you buy? You've got $100,000 you want to protect. You've got this ETF. How many options do you buy to protect that? Come across this question quite frequently. The easiest way to explain it is, if the market went to zero, went all the way down to zero, we would lose the rest of that $90,000. Agreed? Just Hypothetically, it all goes down to 0. We want the put option to pay us back $90,000. That's the protection we're looking for here. If the market's at 0 and we own the 225 put, we're going to get paid 225 times 100, or $22,500 for each option we own. We just said we want to protect $90,000. So how many puts do we need to buy to get $90,000 if each one of them is going to give us $22,500? Fairly simple math, and here it is. The portfolio, this is the equation, the portfolio value that you want to hedge divided by the notional or aggregate value of the strike price. In this case, it's 225 times 100. Do that quick math, and you come to 4 put options. That is the number of options you would need to protect this entire portfolio. Just like I said before, you can then analyze that. You need to buy 4 puts. They each cost $300. That's $1,200 in premium. 3 months out, 10% down, $1,200 cost. You then evaluate that and make a decision for yourself. Do you want to buy that put option or not? One alternative is to buy fewer than 4. Maybe 1, 2, or 3 to lower your cost and protect a part of your portfolio. And of course, we have to assume there's a correlation between the portfolio and the hedge that is 1-to-1 to get this number. If that's not the case, and you have determined that your portfolio moves, say, 3 times faster than the market or 3 times faster than your hedge, you need to buy more puts. You need to buy 3 times more. You're going to lose $90,000 much faster if your portfolio beta is 3 than if it's 1. So if your portfolio is moving quicker than the hedge, you need to buy more. And if it's moving slower than your hedge, you can buy fewer puts. So it would be 4 puts times that ratio that you've come to, you've determined between your portfolio and the hedging tool. On a graph, there's a lot of numbers here. I won't walk through them all, but you can see the most important parts are the percent gain in the market, and then the right side, the overall expected gain loss in the portfolio. As the market moves higher, up 10%, up 20%, flip over to the right side, and we're making money. Consistent with all the other examples we've given today, we profit as the stock moves up, but we're profiting less by a certain amount. How much less are we profiting by? It's $1,200, but it's the cost of the put. I heard that over there. The cost of the put option is a sunk cost. So our overall profit is going to be lowered by that amount. In this case, it's $1,200. And you'll see that 1.2% we're giving up to the upside because we paid for that insurance. What do we get for that? We get the downside protection. Look at how that works. If the market really has an awful 3-month period, something terrible happens, and we're down 20% or 30%, we don't have to worry about those huge, massive losses in our account because we have locked in a worst-case scenario of 11.2. And if we go down 30%, again, you can sell off your hedge if you want, get rid of it, cash it in, and hold your portfolio maybe for a bounce, or continue to hold it. It's tough to know where the bottom is, but sometimes you may have an opinion. In this case, and in the other examples, you could also sell pieces. One of the beauties of options, you can do so many different things with them. If the market did have a correction of 30%, you could sell 1 or 2 or 3 of your options, or 4, and cash in some of your insurance policies. So now I want to get to one of the techniques that was mentioned by the crowd earlier and compare put spreads to protective puts and walk through an example of a put spread. This is very similar to buying a put option. Your strike price determines your exit price, but now we're adding a short put option. What's the delta of a short put option? Long or short? If we sell a put option, we are long delta. We said earlier when we buy a put option and we're long a put option, we are short delta. Market drops, we start to profit. Adding a short put option mitigates that. In fact, it mitigates all of the Greeks. I said in the beginning, when you buy an option, you're long vega. Volatility goes up, price goes up. If you're short an option, the price still goes up, but that's not working against us because we've sold it. So we're short an option, we're short vega. We're also mitigating theta. When we bought an option outright, theta was working against us. Now that we've sold an option, we now have that mitigated. We now have an option where time decay is working in our favor. However, the effect of those is still going to be more exaggerated in the long put. Vega and theta will be higher nearer the at-the-money strike. So we're still net long Vega. We still have a net position that loses due to theta, but it's mitigated with the put spread. So we're trying to reduce costs. We're trying to mitigate our exposures. Those are the benefits we're going to get from doing the put spread, and you'll clearly see we give up massive downside protection. The big drops we give up, and we'll go through an example here. So we can compare the two, same numbers. Stock is trading at $100 a share. We're bullish on the stock. We're long 300 shares from 95, and we want to limit downside risk, but we don't particularly like the cost of just buying a put outright. So we do something a little bit different this time. We see our options chain, and that 90 put that we bought earlier for $535 can now be offset by selling something else. We're going to choose the 80 strike, and we're going to sell that for $275. Fairly aggressive order. We'll go ahead and sell that for $275, just a penny above the bid, and we get filled here. Now we have a put spread with a long position. Stock's up at 100. We're giving up the first 10% before our protection kicks in. But if the stock drops more than 20%, we don't have any protection. The decision on how to choose that strike price can be a little bit difficult. You want to bring in premium. You want to sell an option that brings in enough premium that it's worth it to you. You also can look at where that strike price is. In this case, with the stock at 100, the 80 strike is 20% out of the money. You might determine for yourself that beyond 20% is not something I need to worry about. If that's the case, then selling the 80 put for a relatively meaningful value could reduce your costs and improve your outlook on the trade. It will lower your break-even point. It'll improve your risk profile, knowing you don't have protection beyond a 20% drop in the market. So the resulting position becomes long 300 shares from 95, and now long 3 put spreads from the 80-90 strike at a net cost of $260. Now, as I've said several times, there are so many different ways you can do this. You don't have to sell 3 of the 80 put. You can sell 1 of them and reduce your cost a little bit and keep more protection. Or you can sell 2 of the 80 puts, bring in a little more premium and have more protection. Or you can sell all 3. That choice can be up to you. But the options market provides you that comfort and flexibility to do so many different things, to tweak the insurance you buy in so many ways, that you can do this spread, and you can do it in various ratios. If we do 3 by 3, and we have the 80-90 put spread at $260, here's what the P&L graph looks like. And what you'll notice on the right side as compared to the others, first of all, to the upside, when we just did the outright put at $100 a share, we were still down money. We were still negative. We had not yet recovered the cost of that 90 put. Here we did the spread. So at 100, because we paid less, we're now profitable. Our break-even point has been lowered. What did we give up to get that benefit? Look at the downside. As the stock moves lower, 80, 75, and 70, we now do not have deep, far downside protection. That tail risk is gone. So as the stock moves below our short put strike, we will mount losses, and those losses will continue to grow. In general, this is just a general concept to keep in mind. When you sell options, generally the idea is to pick a strike price that you think the stock or underlying might go to, but not go beyond. Ideally, you want the stock to go right to that strike price and stay there. Now, in this case, this is protective. We don't want the stock to go down at all. We're long the shares. We want the stock to go higher. But when you're selling options, just keeping in mind, you want to pick a strike that you don't think the underlying will move through. And in this case, we think that's 20% down at 80. Now we're going to translate this into a graph. It's always useful to look at this and then determine, is this consistent with my market outlook? And will this position be consistent with what I think is going to happen and my level of protection? So on the upside, we have our break even at 97.60. You'll see in a second on the next slide, I'll put back up what the protective put looks like. But keep in mind here, our break even is 97.60. And our max loss is now considered substantial because the flat line, the protection that we're afforded with this spread, goes between 90 and 80. Beyond 80, there's no protection. If you're perfectly comfortable with that and the value of the 80 put is worth selling, then the put spread may work out better for you. And I'm going to put up a comparison now. As you see where the break-even point is, and you see the downside in the stock, how that works, back to the protective put, the more simple example, the break-even's higher. In this case, it's about 3% higher. That's significant. We increase our break-even point up above $100 a share because we did not sell the 80 put. Our maximum loss now has been locked in. So again, when you're trading options and you're evaluating a position or you're evaluating managing a position, there's going to be a cost and there's going to be a benefit, an advantage and a disadvantage. There's always two sides to that. And I rarely use the word always, but it's always there. When you compare these two, protective put versus using the put spread, the protective put costs us a higher break-even point, but we gain the full protection of maximum loss at 31.05. And there you can see, identified that break-even point. And the break-even point in general, just to put that into context, the break-even point translates into the probability of profit. Your break-even point of 135 means the stock has to go 3% higher for you to make money. A lower break-even point increases the chances that you're going to be profitable on the trade. Someone mentioned covered call earlier. That's what you're trying to do when you sell a covered call against a long stock position. Same thing. Lower your break-even point to try and increase your likelihood of being successful. You now have some wiggle room. You have some flexibility on where you can be profitable. So that protective put has an increased break-even point, but full protection. If you're more aggressive and not concerned about tail risk, the put spread would work out better for you. If you want to sleep at night and you're concerned about something terrible happening in the market and you're willing to pay a little more for it, then the outright protective put may be the way you lean. And this is a summary of that. The spread only has protection down to its short strike price. Beyond that, there is no protection. The protective put takes care of you all the way down to zero. And what you give up for that is the cost. The protective put costs more than the put spread. And profit potential certainly is greater with the put spread because you've spent less. So if your cost is less, your potential gain is greater as well. So that's a comparison of put spread to protective put. Now to sort of summarize and put all of that together, the protective put, the index, the put spread, the key takeaways here. Buying put gives the owner the right to sell shares at the strike price. You pay for that up front. It's very similar and very comparable to buying any other form of insurance. You can use it to protect a stock position or a portfolio. We walked through how to do that, identifying an index or an ETF, and how to calculate how many puts to buy against a portfolio. Also, you can ratio your puts. Protect a full portfolio or half or a quarter, and then using the put spread. You can do the same thing. You can sell puts that are further out of the money that you're not concerned about, and you can sell a full-size position or a quarter or a half and change your quantities as you see fit. The deductible can be calculated. This is usually where you start when you try to construct the trade. How much am I willing to give up? What level of a market drop can I tolerate before the protection kicks in? That is equal to your deductible. You start there when you construct the trade. And again, the put spread has advantages and disadvantages. The great one is lower cost, lower break even, higher likelihood of success, but you give up that tail risk and downside protection. So that outlines and summarizes what we went through today. Again, go back to our website. We've got the Options Education Program. You can download some videos and podcasts. You can email our investor services team. Contact information is here. Optionseducation.org is where it's all at. The email address For the investor services team, options@theocc.com, and social media, YouTube, Facebook, and Twitter. So go follow us there and check out all of the videos that we have available for you. But I do thank you for your attention on session 1. I hope you learned something. And we're going to be looking forward to Jamal coming up in session number 2.